Welcome back to your go-to podcast for smart money moves and financial growth. You want to make money, right? You want to build wealth and secure your financial future? Well, you've come to the right place. Today, we're diving into two major topics: how tariffs impact investment opportunities and how to make more income when the stock market is falling. So buckle up, get ready to take some notes, and let's jump in. Listen up, folks. When those tariff pronouncements hit the news, the market goes wild. Investors get jumpy, they start selling, buying. It's a roller coaster of emotions and stock prices. One minute you think you're riding high with the Dow, the next minute you're staring down the barrel of a correction. Remember the US-China trade war? Tariffs flew faster than hotcakes at a church bake sale, and the market went haywire. Volatility is the name of the game when tariffs enter the picture. For the savvy investor, it spells opportunity. While others are running for the hills, we're going to be there ready to pick up the bargains. Stay tuned, because I'm about to break down exactly how tariffs can impact your portfolio and, more importantly, how you can profit from it. Now let's talk business, because that's where the rubber meets the road. When tariffs hit, companies relying on imports start sweating bullets. Their costs skyrocket faster than a SpaceX launch, and their profits? Well, let's just say they start looking thinner than my patience with a slow stockbroker. Take those companies dependent on cheap Chinese steel, for instance. Suddenly, their input costs go through the roof, and their stock prices? They take a nosedive faster than a pelican after a tuna. But here's the flip side. Domestic producers start singing a different tune. Think of the US steel industry. With tariffs in place, they've got a competitive edge, their products become more attractive, and bam! Their stock prices start climbing. The lesson here, folks, is this: when tariffs hit, it's not a one-size-fits-all situation. The key is to identify the winners and losers, and to position your portfolio accordingly. All right, folks, let's get granular. Let's talk sector-specific opportunities. When those tariffs start flying, certain sectors become hotter than a fire sale at a tech gadget store. Manufacturing, my friends, that's where the action is. Companies are scrambling to bring production back home, and that means investing in factories, equipment, and jobs, baby. And hey, don't sleep on emerging markets. These guys are often less reliant on global trade, and with less exposure to tariffs, they become a safe haven for savvy investors. While the big boys are busy duking it out in a trade war, these emerging markets are quietly building their economies and attracting capital. All right, you currency cowboys and Forex fanatics, this one's for you. Tariffs can shake up the greenback and send those exchange rates on a wild ride. When a country slaps on tariffs, it can slow down trade, weakening their currency. Less trade means less demand for that country's currency. For you Forex traders, this is where the real money is made. Imagine this: you see a country about to get hit with tariffs, you short that currency, and when it drops, you cash in. But remember, Forex trading is not for the faint of heart. Listen up, my dividend devotees. When the market's doing the jitterbug and your portfolio feels like it's on a roller coaster, there's one word that should be music to your ears: dividends. Think of them as your financial cushion, a steady stream of income no matter what the market throws your way. Now, I'm not talking about those penny ante dividends that barely cover the cost of a cup of coffee. I'm talking about those juicy, substantial dividends that can make a real difference in your portfolio. We call them dividend aristocrats, the royalty of the stock market. These are the companies that have weathered recessions, market crashes, and yes, even tariffs, and they've come out on top, still paying out those sweet, sweet dividends. All right, thrill seekers and risk takers, this one's for you. Let's talk about short selling, the Wall Street equivalent of betting against the house. You see a company that's about to get hammered by tariffs, their stock price is heading south, so you borrow their shares, sell them at the current price, and then wait for the price to drop. Once it's down, you buy back those shares at the lower price, return them to the lender, and pocket the difference. It's like selling high and buying low, only in reverse. But let me be clear. Short selling is not for beginners. It's a highly specialized strategy that requires nerves of steel, a deep understanding of the market, and a healthy dose of intestinal fortitude. Now, let's talk about a strategy that's a little less heart-stopping than short selling, but can still deliver some serious returns in a downturn. Inverse ETFs. These bad boys are like the superheroes of the ETF world. They thrive when the market takes a dive. Regular ETFs track the market, they go up when the market goes up, and they go down when the market goes down. But inverse ETFs, they do the opposite. They're designed to increase in value when the market falls. So, if you're worried about tariffs dragging down the market, consider adding some inverse ETFs to your portfolio. They can help hedge your bets and reduce your overall risk. Let's face it, folks, sometimes the stock market can feel like a casino. But fear not, because there's one asset class that's as solid as the ground beneath your feet. Real estate. When those stock prices start doing the jitterbug, real estate can be your rock, your anchor, your safe haven from the storm. I'm talking about investing in solid, income-producing properties that provide a steady stream of cash flow, month after month, year after year. Think rental properties, commercial real estate, even REITs, which are like mutual funds for real estate. These investments can provide stability, diversification, and a hedge against inflation. All right, hustlers and entrepreneurs, this one's for you. Relying solely on the stock market is like putting all your eggs in one basket. And we all know what happens to baskets, don't we? They break. That's why it's crucial to diversify your income streams, to create multiple avenues of revenue, and to build a financial fortress that can withstand any storm. The internet has created a world of opportunities. You could start a blog, launch an online course, sell handmade goods on Etsy, or become an affiliate marketer. The possibilities are endless, and the best part is, you can often start these ventures with little to no upfront investment. Listen up, bargain hunters and value investors. This one's for you. Market downturns, as scary as they seem, are often the best time to load up on those blue-chip stocks, those industry titans, those companies that are built to last. It's like shopping at a Black Friday sale, only instead of TVs and toasters, you're buying pieces of America's greatest companies. Now, I'm not talking about catching falling knives, remember? Timing the market is a fool's errand. But when you see a solid company with strong fundamentals trading at a discount, that's your signal to pounce. So when the market throws a tantrum and those stock prices plummet, don't panic. Take a deep breath, do your research, and look for those golden opportunities to buy the dip. And there you have it. Tariffs can shake up markets, but they also create opportunities if you know where to look. Remember, volatility isn't your enemy. It's your chance to make some serious money if you're prepared. And when the stock market falls, it doesn't mean the end of your wealth-building journey, it just means shifting strategies. Diversify, explore those side hustles, and remember, fortunes are made when others are fearful. If you found this episode valuable, don't forget to like, subscribe, and hit that notification bell so you never miss an update from. Thanks for tuning in, and remember, opportunities are everywhere.